DSCR Rate and Term refinance right for you? Because here's the truth. Most investors asking that questions are asking it at the wrong time, for the wrong reasons, or to the wrong lender. And that mistake is costing them thousands of dollars a year in cash flow they are leaving on the table.
Oh my God!
I have had investors come to me after spending 6 months going back and forth with a lender that never got them to closing. I have had investors told, "You are approved," only to get hit with surprise requirements the week before closing. And I have had investors who refinanced their rental property, got a better rate, and somehow ended up with worse monthly cash flow because nobody walked them through the full picture. Today, I am going to fix all of that. I am Eli, the DSCR Pro, and in this video, I am going to break down exactly when a DSCR rate and term refinances make sense, when it doesn't, what kills most refinance applications before they even get started, and how to structure your deal so you actually win, not just on paper, but in your bank account every single month. Here is what we are going to cover. First, the single biggest reason DSCR rate and term refinances get denied, and it has nothing to do with your credit. Second, why wanting a lower payment and maximum cash flow at the same time is setting you up to fail. Third, what to do when the rate today isn't that much better than what you already have. And if you stay until the end, I am going to show you the right way to frame a DSCR rate and term refinance. The questions every serious investor should be asking before they ever call a lender. Let's get into it. Section 1, the cash flow problem and the ratio behind it. Let's start with the number one reason DSCR rate and term refinances fall apart. The property doesn't cash flow enough. Now, I know what you're thinking. Eli, I am collecting rent every month. My property cash flows. Maybe it does, but here is the thing lenders care about. They are not just looking at your rent check. They are calculating your DSCR, your debt service coverage ratio, which means they are dividing your gross monthly rent by your full housing expense. That includes principal, interest, taxes, insurance, and sometimes HOA dues. So if your rent is $2,200 a month, but your new payment with taxes and insurance come out to $2,100, your DSCR is only 1.05. Some lenders will do that, some won't. And if your insurance premium is high or your property taxes are hefty, that ratio can drop below 1, which means the loan gets denied even though the property is occupied and generating income. Insurance reality check. What changed in 5 years in 2020? A typical investment property insurance policy might have cost $1,800 per year. That same property today easily $3,200 to $3,800 per year. That is an extra $150 to $170 per month added at your PITI. That wasn't there 5 years ago. And lenders use today's insurance cost in your DSCR calculations, not what you paid at the purchase. Here is something a lot of investors don't realize, and this is where it has gotten brutally in the last few years. Insurance premium on investment properties have exploded. In 2020, you might have been paying $1,800 a year to insure a single family rental. That same property today, easily $3,200 to $3,800. A DSCR rate and term refinance that would have sailed through in 2020 might be a borderline today purely because of insurance inflation. So what to do? Shop your insurance aggressively before you apply. Get at least 3 quotes. A difference of $800 to $1,000 per year in premium is not unusual when you shop it properly. And that can be the difference between a DSCR of 1.02 and a DSCR of 1.15. That gap matters. Now let's talk about taxes, because this is one of the most underused tools I see investors leave on the table, especially here in the tri-state area. In high tax markets like New York, New Jersey, and Connecticut, property taxes on an investment property can easily run $8,000, $10,000, $12,000 a year or more. That is $700 to $1,000 a month sitting inside your PITI, pushing your DSCR down. But here is what most investors don't know. You can fight that number. It is called a tax grievance, a formal challenge to your property assessed value, and if your property has been overassessed relative to current market conditions, you may be able to get that tax bill reduced. In New York, for example, tax grievance filings are processed annually. Unsuccessful challenges can cut hundreds or even thousands of dollars of your annual tax obligation. I have seen investors reduce their property tax bill by $1,500 to $2,500 per year through proper grievance filing. On a DSCR calculation, that is a meaningful improvement. Tax grievance attorneys typically work on contingency. They only get paid if they win. So there is almost no reason not to try it before you apply for your DSCR rate and term refinance. Here is the takeaway from this section. Before you ever call a lender about a DSCR rate and term refinance, look at the two expenses inside your PITI that you actually have some control over: insurance and taxes. Get quotes on a better insurance policy. If you are in a high tax area, talk to a tax grievance attorney. Those two moves alone might solve your cash flow problem before you even submit an application. Section 2, the cash out trap, the rate trap, and the smarter structure. Here is the second issue I see constantly, and it is a mindset problem more than a lending problem. An investor calls me and says, "Eli, I want to lower my payments and pull out $50,000 in equity." And I have to tell them the truth. Those two goals are often working against each other. More cash out means bigger loan balance. A bigger loan balance means higher payments. You cannot always have both at the same time. And any lender that tells you otherwise without running actual numbers is setting you up for last-minute surprise. So what to do? You decide what your actual priority is. If the goal is monthly payment relief, limit your cash out or skip it entirely and do a DSCR rate and term refinance. If the goal is pulling equity to redeploy into another property, accept that your payment may not drop as much as you hope. Structure the loan around your real goal, not a fantasy that combines three wishes into one. But here is where it gets interesting, because there is a third option most investors don't know exists, and this is where smart leverage really comes into play. What if you could do both? Not in the same loan, but through two separate moves working together. The two loan strategy. Step 1, do a DSCR rate and term refinance on your first mortgage. Lock in better terms, lower your monthly payments, keep the loan balance clean. Step 2, take out a DSCR second mortgage on the same property to access your equity. Use it for repairs, a down payment on another investment property, or to cover costs while stabilizing a new acquisition. Result, lower payment on the primary loan plus the liquidity you need without jamming them into a single structure that compromises both. Here is the strategy. You do a DSCR rate and term refinance on your first mortgage to capture the lower rate and reduce your monthly payment. That is the primary goal. Lock in better terms. Improve cash flow. Keep the loan balance clean. Then separately, you take out a DSCR second mortgage on the same property to access your equity. Those two, they don't have to be done at the same time. So you don't have to start paying interest on the money that you are not using. That second loan functions essentially like a bridge loan. You use those funds for repairs, renovations, a down payment on another investment property, or to cover costs while you are stabilizing new acquisitions. So instead of bloating your first mortgage to pull cash and killing your DSCR ratio in the process, you keep the first loan lean and let the second mortgage do the capital work. You get the lower payment on the primary loan and the liquidity you need without jamming them into a single structure that compromises both. At DSCR Pro, we offer DSCR second mortgage products specifically designed for a situation like this. It is one of the most underutilized tools in a rental property investor's toolkit, and most lenders either don't offer it or don't think to suggest it because they are just focused on originating the one loan in front of them. We look at the full picture. Now, here is the second trap I want to address, the rate trap. Investors sometimes call me and say, "Eli, should I refinance?" I ask what rate they are at. They tell me, and we quickly realize today's DSCR rates aren't dramatically better than what they already have. So they assume the DSCR rate and term refinance doesn't make sense. But here is what they are missing. A DSCR rate and term refinance is not always about getting lower rate. Sometimes it is about restructuring the loan entirely, going from a 20-year to a 30-year amortization, adding an interest-only period, or eliminating short-term debt that has been strangling your cash flow. The rate is one one variable. The full payment structure is what you actually determine whether you win. And when you combine a cleaner first mortgage with a DSCR second mortgage for capital deployment, you have built a financing structure that most investors and most lenders never even consider. Section 3. What kills the deal before it starts? Equity, appraisal, and documentation. Let me talk about 3 things that quietly kill DSCR rate and term refinances before the investor even knows what happened. The first one is equity or the lack of it. If your property value hasn't appreciated much since you bought it, or if your current loan balance is still high relative to the value, you may not meet the lender's loan to value requirement. Most DSCR rate and term refinances want you at 75% LTV or better. If you're at 80 or 85%, your options get more limited and more expensive. The fix? Wait for more appreciation. Make target improvement that increase value or challenge a low appraisal, which brings me to the second deal killer, the appraisal itself. And this is where I want to give you a piece of advice that most lenders will never tell you. Not all appraisals are created equal, and on an investment property, that difference can cost you tens of thousands of dollars in accessible equity. Here is what happens more than it should. A lender orders an appraisal from a general pool of appraisers. The appraiser assigned to your property may be perfectly qualified, but they work all over the region and sometimes over the country. They are not deeply familiar with your specific neighborhood, and they are pulling comparable sales from a wide radius that may not actually reflect that properties on your block are actually worth. In tight urban markets, in the tri-state area especially, values can shift dramatically street by street. An appraiser who doesn't know that your neighborhood has been appreciating faster than the surrounding zip code is going to undervalue your property, and there is no malice in it. They just don't have the local knowledge. The same problem shows up on the rental income side. DSCR appraisals include rent schedule, an appraiser's estimate of what the property should rent for at market rate. If the appraiser isn't familiar with local rental demand, they may assign a below market rent figure to your property. And since your DSCR ratio is calculated using that appraisal rent, not just what your tenant is currently paying, an inaccurate rent schedule can directly hurt your ratio and your loan approval. Local appraiser advantage. At DSCR Pro, we work to match your property with appraisers who have demonstrated experience in your specific market. Someone who knows local comps, understands rental demand in that neighborhood, and can support an accurate value and an accurate rent schedule. That is potentially the difference between a loan that closes at the term you need and one that comes back short. Beyond appraiser selection, prepare for your appraisal like it is an interview. Bring your rent rolls, bring your leases, bring a list of every upgrade you have made to the property. Bring comparable sales that support a higher value. Appraisers respond to documentation. If you just sit back and hope the appraiser figures that, you are leaving money on the table. The third silent killer, rental income documentation. Even your property is rented and the rent is coming in, sloppy documentation can seriously hurt your file. Missing leases, inconsistent deposits, month-to-month tenants, rents that are below market, all of that create problems in underwriting. Clean up the file before you apply. Get signed leases. Have your rent roll ready. Make sure the income story is clear and airtight. The easier you make it for the underwriter, the faster and cleaner your approval goes. One of my clients, Desmond, came to me with a 2-property situation where the documentation was a mess. Not his fault, just years of informal arrangements. Tanya and my team sat with him, helped him get the file organized, and we got him closed on his second investment property using a DSCR loan. He left a review saying the whole team was meticulously detailed in their approach. That is exactly what a good DSCR lender should be doing. Not just processing your loan, but helping you build the strongest possible file. Section 4, credit, property type, and the long game. 2 more things I want to cover before we get to the most important part, credit. DSCR rate and term refinances are more flexible than conventional loans. You don't need to show your tax returns, your W-2s, your pay stubs. The property's income does the heavy lifting, but credit still matters for pricing. If your score is below 680, you're likely paying a higher rate or more points. The difference between a 660 and a 720 score on a DSCR loan can be between 0.375 to 0.75 on the rate. And over the life of a 30-year loan, that is real money. If your credit needs work before your refinance, that is not bad news. It is a strategy conversation. Pay down revolving balances, clear up any errors on your report, and avoid opening new accounts. Even a 20 to 30 point improvement can meaningfully change your pricing. Property type is the other one. Certain properties create friction with lenders. Short-term rentals, mixed-use buildings, rural properties, condos with non-warrantable status. These aren't impossible, but they require the right lender. At DSCR Pro, we work with 30 plus lenders across 48 states. We know which lenders are comfortable with which property types, and that is exactly how we take a deal that looks dead on paper and find it at home. I was talking to Jason Henry recently. He's a top producing agent who sends us his investor clients, and he told me something that stuck with me. He said, Eli doesn't just process loans. He strategizes to help deals close. That is the difference between working with someone who just punches in numbers and working with someone who actually understands the investment side of what you're trying to build. Section 5, the right way to think about a DSCR rate and term refinance. Here is the thing that ties all of this together. The investors who win with DSCR rate and term refinances are not the ones chasing the lowest rate. They are not the ones trying to maximize cash out while also minimizing the payment. They are the ones who ask one specific question. How do I structure this DSCR rate and term refinance to maximize monthly cash flow while preserving flexibility? That question forces you to look at all variables together: loan amount, rate, amortization, interest-only options, prepayment penalty, reserves, and how the DSCR ratio actually lands with the lender. Most of the time, you can get 2 of the 3 things you want: lower payment, cash out, and easy approval without much friction. Getting all 3 at once requires the right structure, the right property documentation, and the right lender. And that is exactly what we do at DSCR Pro. No surprises, no moving goalposts, no getting a yes in week 1 and we need one more thing in week 6. We tell you upfront what we need, what rate you are looking at, and when we can close, and then we deliver on it. So let me give you the simple checklist before you call any lender about a DSCR rate and term refinance. Run your property's actual DSCR. Take your gross monthly rent divided by the full projected payment, including taxes and insurance. Above 1.25, you are in great shape. Between 1 and 1.25, workable but needs the right lender. Below 1, fix the income or payment structure first. Know your priority: lower payment or cash out. Pick one as the primary goal and structure around it. Or ask us about the 2 loan strategy. Get your file clean, sign leases, rent roll documentation in order. Don't let a sloppy file slow down an otherwise approvable deal. Know your credit score before you apply. If it is under 680, ask us about a 60-day credit improvement strategy before you submit. Work with a lender who has options, not one lender, not 2 lenders. At DSCR Pro, we have relationship with 30 plus lenders. If one door closes, we find another one. Thinking about using short-term rentals to boost cash flow? Click the next video, Airbnb tips, and see which moves help you keep more profit and avoid mistakes that quietly drain your margins.